They called it, they saw it coming. While most of the market was celebrating silver's historic rally, while retail investors were stacking coins and talking about $150 targets, while the bulls were so confident they stopped even considering the downside, two of the most respected names in the trading world were quietly warning anyone who would listen that something ugly was coming. And then it came. Silver crashed 30% in a single session. The worst day since 1980. The worst day since the Hunt brothers tried to corner the market. And the whole thing blew up in their faces. Nearly half a century of trading history, and what happened last week sits at the very top of the list for single-day destruction. But here's what makes this story different. Here's what separates this moment from all the noise and panic you're seeing everywhere else. The same people who called the crash, the same legendary traders who warned you this was coming, have now flipped. They're not bearish anymore. They're bullish. And when people with that kind of track record change their minds that quickly, you pay attention. I'm talking about Peter Brandt, a futures trading legend with over 50 years of experience. Someone whose calls have been studied and cited by traders around the world. I'm talking about Marko Kanovich, a former JP Morgan strategist who spent 16 years at the bank, worked at Merrill Lynch and Bear Stearns before that, and was inducted into the Institutional Investor Hall of Fame for his market calls over more than 2 decades. These are not random people on the internet making predictions. These are Hall of Fame level analysts with track records that span generations. And they just switched from bearish to bullish in the span of days. That flip matters. It matters more than any chart pattern I can show you. It matters more than any indicator reading. Because when people who called the exact top are now saying the bottom might be in, the market is telling you something important about what comes next. Quick favor before we dive deeper, I'm building something real here at Financial Crux. And moments like this are exactly why independent analysis matters. The mainstream will tell you to panic. The cheerleaders will tell you to buy blindly. Neither approach serves you. If you want analysis that actually helps you make better decisions, subscribe and drop a comment below. In the days leading up to the collapse, Peter Brandt was publicly warning that silver was exhibiting classic blow-off top characteristics. For those who don't know the term, a blow-off top is when a market that has been rallying goes into a final parabolic phase where prices accelerate almost vertically. Volume spikes, euphoria takes hold. Everyone who is skeptical capitulates and joins the bull side. And then, right when consensus reaches its peak, the market reverses violently. Brandt has been trading futures since the 1970s. He's seen this pattern more times than most of us have seen birthdays. And when he looked at silver's chart, with prices up nearly 250% over the past year, with the rally accelerating in the final weeks, with retail enthusiasm reaching fever pitch, he recognized what he was looking at. He warned that a major move lower was coming. Marko Kanovich was even more specific. He predicted a potential 50% decline for silver in the coming year. That's not a hedge. That's not a cautious warning. That's a direct quantified call that the metal was massively overextended and due for a reckoning. Both of them were right. Brutally, painfully, historically right. Silver's 30% single-day crash was worse than almost anyone expected. It blew through support levels like they didn't exist. It triggered margin calls across the entire futures complex. It wiped out months of gains in hours, and it reminded everyone that the same volatility that creates 250% rallies can create 30% crashes just as easily. But here's where the story gets interesting, because Brandt and Kanovich didn't just call the top and disappear. They didn't just take a victory lap and move on to other markets. They came back, and when they came back, they had a different message. They're now tactically bullish. They're looking for a bounce. They believe that the selling has been violent enough, extreme enough, overdone enough that the conditions for a recovery are now in place. Let me explain why this flip matters so much, because it's easy to dismiss it as just another opinion change. First, there's the credibility factor. Most analysts who make bold calls and get them right immediately become even more confident in their original thesis. They double down. They say the crash is just the beginning, that more pain is coming, that anyone buying here is catching a falling knife. That's the normal playbook. Brandt and Kanovich did the opposite. They looked at the aftermath of the crash, assessed the new information, and concluded that the risk-reward had shifted. That takes intellectual honesty. That takes the ability to separate ego from analysis. That takes the kind of flexibility that makes someone successful over decades, rather than just having one good call. Second, there's the information they're processing that most retail investors don't have access to. People at this level see flows, they see positioning data, they see the behavior of institutional money in real time. When they flip from bearish to bullish, it's not because they woke up feeling optimistic, it's because something in the data changed. Third, there's the historical pattern they're recognizing. In commodities, the sharpest crashes often create the sharpest bounces. The selling capitulation that drives prices down 30% in a day also clears out the weak hands, triggers short covering, and creates the conditions for violent mean reversion. That's not always true, but it's true often enough that experienced traders respect the pattern. Now let me walk you through what's actually supporting the bullish case, because a flip of this magnitude needs to be backed by more than just one or two analysts changing their minds. The first factor is the severity of the selling itself. When you have a 30% decline in a single session, you're not looking at normal profit taking. You're looking at forced liquidation, margin calls, systematic fund deleveraging, panic selling by retail traders who couldn't handle the drawdown. All of that activity is exhaustive. It burns itself out. And once it burns out, the sellers are gone. Think about it this way. If you were going to panic sell silver, you probably already did it. If your margin call was going to force you out, it already did. If your stop loss was going to get triggered, it already got triggered. The people who remain in the market after a crash of this magnitude are either committed long-term holders or fresh buyers looking to take advantage of the chaos. That shift in the composition of market participants is exactly what creates conditions for a bounce. The weak hands have been flushed, the strong hands remain. And when new buying emerges, there's less overhead supply to absorb it. The second factor is the technical setup that now exists. When silver was trading above $110, the chart looked dangerously extended. RSI was above 80. Price was far above all major moving averages. Every technical indicator was screaming overbought. That kind of setup makes bounces likely to fail and corrections likely to accelerate. Now the picture is reversed. RSI has collapsed from extreme overbought to oversold territory. Price has crashed back to the 50-day moving average, which is acting as a support zone. The market has gone from dangerously extended to potentially compressed. That's the kind of setup where bounces have a higher probability of sticking. I want to be clear about something here. Oversold doesn't mean buy blindly. Oversold markets can stay oversold. They can even get more oversold. But oversold in the context of legendary traders flipping bullish is a very different signal than oversold in isolation. The third factor is what's happening in the physical silver market. And this is the part that most people are not talking about. There is a growing disconnect between paper prices and physical silver availability. During the crash, the futures market collapsed. Prices on screens dropped 30%. But try actually buying physical silver at those prices. Good luck. Premiums at coin dealers remain elevated. Inventory is tight. Delivery times are extended. The paper market and the physical market are telling different stories. This disconnect is not new. It's been building for months. As industrial demand, central bank accumulation, and retail stacking have all competed for limited supply. The crash in paper prices didn't magically create more physical silver. The supply situation remains tight, and eventually tight supply has to be reflected in prices. There's a term that traders use for this situation. They call it paper fire sale. It means the futures market is selling off for reasons that have nothing to do with actual supply and demand, creating a temporary dislocation that eventually corrects. That's exactly what Brandt and Kanovich appear to be betting on. The fourth factor is the margin situation, and this is crucial for understanding the mechanics of what just happened. The CME raised margin requirements for silver futures right as the crash was accelerating. That margin increase forced leveraged traders to either put up more capital or liquidate their positions. Most chose to liquidate. That forced selling became a self-reinforcing cascade that drove prices far below where fundamentals would suggest. But here's the thing about margin-driven selling. It's not based on a view about silver's value. It's mechanical. It's forced. It's the exchange protecting itself from counterparty risk. And when that kind of forced selling exhausts itself, the market often snaps back toward fair value because the selling was artificial, not fundamental. The new higher margins also mean that the speculators who might have been tempted to pile back in with heavy leverage will be more constrained. That actually creates a healthier market structure. Less leverage means less violent swings in both directions. It means the next move is more likely to be driven by real supply and demand rather than just positioning games. Now, let me address the other side of this because I'm not going to pretend that everything is bullish just because two respected analysts change their view. There are legitimate reasons to remain cautious about silver here, and you need to understand them before making any decisions. First, the industrial demand picture is genuinely concerning. Silver is not just a monetary metal. It's an industrial commodity with massive exposure to manufacturing, electronics, and solar panel production. And right now, the global industrial outlook is weakening. China's economy is slowing. European manufacturing is struggling. Even in the US, the manufacturing sector has been in contraction territory for extended periods. When industrial demand weakens, it directly impacts silver consumption. And unlike gold, which is almost purely a monetary and jewelry metal, silver has to justify its price based on both investment demand and industrial use. If the industrial side stays weak, it creates a headwind that even strong investment demand might not overcome. Second, the interest rate environment remains challenging. The Federal Reserve has not pivoted as aggressively as many expected. Rate cut expectations have been scaled back, and with stronger than expected economic data coming out of the U.S., there's a growing possibility that rates stay higher for longer than the precious metals bulls were anticipating. Higher interest rates create opportunity cost for holding non-yielding assets like silver. When you can earn 4 or 5% in treasury bonds with zero risk, the calculus for holding silver changes. You need to believe in significant price appreciation to justify foregoing that yield. And when rate expectations shift hawkish, that calculus shifts against precious metals. Third, the dollar remains strong. The Trump administration's nomination of Kevin Warsh for Fed chair has strengthened the dollar significantly. A stronger dollar makes silver more expensive for international buyers and historically correlates with pressure on commodity prices. If the dollar strength continues, it creates an ongoing headwind for any silver recovery. Fourth, the technical damage is real. Yes, conditions are oversold. Yes, a bounce is possible. But the structures that took months to build were destroyed in a single session. Key support levels that everyone was watching are now overhead resistance. The 200-day moving average, which should be support, might now act as a ceiling on any rally attempt. Markets that crash this hard don't typically V-bottom and immediately resume their prior trend. More commonly, they chop around, retest lows, build a new base over time, and only then begin a sustainable recovery. That process can take weeks or months. Traders expecting an immediate return to $100 or $110 are likely to be disappointed. So, how do you reconcile the bullish flip from legendary traders with the legitimate concerns that remain? The answer lies in time frame and expectations. Brandt and Kalanovich are talking about a tactical bounce, not a return to all-time highs next week. They're saying the selling is overdone, not that all problems are solved. They're looking for mean reversion from extreme conditions, not a new bull market beginning immediately. That's a very different thing from the permabull narrative that says silver is going to $150 and you should buy with both hands right now. It's more nuanced, it's more realistic, and it's probably more useful for anyone trying to actually make money in this market. The trade they're implying is a shorter-term bounce play, something that benefits from the snapback after extreme selling, something that might capture a 10 or 15 or 20% move as the market stabilizes, not a hold forever and wait for the moon type of play. That's an important distinction because it changes how you should think about position sizing, risk management, and exit strategy. A tactical bounce play requires different treatment than a long-term accumulation strategy. Now let me give you a framework for how to think about silver from here. Because knowing that smart money has flipped bullish is only useful if you know how to act on that information. First, understand that the bounce may have already started by the time you watch this. Markets move fast. The same volatility that created the crash can create rapid recoveries. If silver has already bounced 10% from the lows, you're not getting the same risk reward that existed at the bottom. Second, define your levels before you act. The 50-day moving average around $73 is the immediate support that needs to hold. A bounce that reclaims $80 would be the first sign of stabilization. A move back above $85 would suggest the worst is over. And the key resistance level that would confirm a trend recovery is 8375, the December high. On the downside, a break below $70 would suggest the bounce thesis is wrong, and further declines toward the 100-day moving average at $60 are in play. Third, size appropriately for the volatility. If you're going to play a bounce in a market that just crashed 30%, you need to assume that volatility remains elevated. That means smaller position sizes than you might normally use. That means wider stops to account for the chop. That means accepting that you might be wrong and structuring your trade so that being wrong doesn't destroy you. Fourth, have an exit plan before you enter. The bounce could be 10%, it could be 20%, it could fizzle and reverse. Knowing in advance what would make you take profits and what would make you cut losses is essential. Don't enter a trade hoping to figure it out later. Fifth, recognize that the long-term picture remains uncertain. A tactical bounce doesn't mean the bull market has resumed. It means the selling got overdone and a snapback is likely. After that snapback, the market will have to prove that it can sustain higher prices. That proof might take weeks or months to develop. Let me share some thoughts on what the behavior of these legendary traders tells us about markets in general, because there's a lesson here that goes beyond silver. The willingness to flip from bearish to bullish in the span of days is not weakness. It's not indecision. It's not flip-flopping. It's exactly how successful traders operate. They follow the market, not their ego. They update their views when new information arrives. They recognize that being right once doesn't mean being right forever. Most retail traders do the opposite. They form a view and then defend it regardless of what the market does. They get bullish and stay bullish even as prices crash. They get bearish and stay bearish even as prices recover. They make their thesis part of their identity and then can't change it without feeling like they're betraying themselves. That's not trading, that's religion, and religion doesn't make money in markets. The Brandt and Kolanovich flip is a masterclass in flexibility. They called the crash. They were right. And instead of becoming attached to the bearish thesis that made them right, they immediately started looking for what comes next. They recognized that the conditions that justified being bearish were no longer present after a 30% crash. And they had the intellectual honesty to say so publicly. That's the mindset that survives and thrives over decades. That's the mindset that compounds wealth instead of destroying it. And that's the mindset I try to bring to every analysis I share on this channel. Here's my question for you, and I genuinely want to see this discussion in the comments. Did you hold through the crash? Are you considering buying now? Or are you still too shell-shocked to even think about silver? There's no wrong answer, but your answer reveals where you are in your own development as a trader or investor. The people who can think clearly right now, who can assess the situation without being overwhelmed by emotion, who can consider that the bottom might be forming even as they process the pain of the crash, those are the people who will eventually profit from moments like this. Drop your thoughts below, share what you're seeing, tell me what you're thinking about doing. That kind of community discussion is invaluable during periods of extreme volatility. Before I wrap up, let me remind you that the links to the WhatsApp community and X are in the description. During periods like this, real-time updates matter. By the time I can produce a full video, the market may have moved significantly. The WhatsApp community and X feed provide the quick takes that help you stay informed as situations develop. Let me leave you with some final thoughts on what this moment represents. Silver just experienced something historic, not historic in the good way. Historic in the painful, shocking, wealth-destroying way. Many people who were riding high just a week ago are now dealing with significant losses. Some are dealing with catastrophic losses, but embedded within that pain is opportunity. The same volatility that creates crashes creates bounces. The same force that drove prices down 30% can drive them up 20% just as quickly. The question is whether you're in a position to capture that opportunity or whether the crash took you out of the game entirely. If you're still in the game, if you still have capital and clarity, you're looking at one of the most interesting setups in silver in years, not necessarily for a long-term hold, not necessarily for a return to all-time highs, but for a tactical bounce that could deliver meaningful returns for those who time it right. The legends have spoken, they called the top, they called the crash, and now they're calling for a bounce. That doesn't guarantee they're right. Nothing in markets is guaranteed, but when people with that kind of track record flip their view, it's worth paying attention. Stay sharp, stay flexible, and remember that the best traders are the ones who can change their minds when the evidence changes. I'll see you in the next.